yesterday the Fed made another rate cut. Here's Jerome Powell.
Total PCE prices rose 2.8% over the 12 months ending in September. And excluding the volatile food and energy categories, core PCE prices also rose 2.8%.
And based on that, he decided that would require another little nudge to drop the rates down another 0.25 basis points. Joining us now to talk about what this means to you in regards to your money, your credit cards, your mortgage is Dan Varroney. He is a strategist and the author of the #1 Amazon best-selling book, Rethinking Economic Growth. Dan, welcome to our show.
John, it's a pleasure to be with you, and happy Thursday morning.
Happy Thursday indeed. And I guess this is a very happy Thursday for those people out there who are working in the mortgage business, or I guess maybe in the banking business.
So it actually is. So let's look at this first from a consumer perspective. So if you've got a variable rate mortgage, you're going to see a downward hit, positive hit, meaning you pay less on your mortgage. For those with fixed rate auto loans, however, you're not going to see anything different. If you've got a variable rate auto loan, you could see a downward positive hit and pay lower on your payments. Your credit card interest rates, probably you're going to see a little bit of a dip, which is also very, very good sign. But with, as they say with some of the good news, there's always a little bit of bad news. So for those close to retirement or at retirement, if you got money in money markets, you're going to see those interest rates down a bit. But overall, there have been 3 25 basis point cuts this year, which is very good news for consumers. Again, those with variable mortgages, good news. Those with credit cards, good news. And we're moving in the right direction. But, John, now that I said that, let me talk about why it really matters to your listeners, especially the small businesses, if I might.
Sure.
My new book came out 2 months ago. I did 35 interviews with 35 small business owners around the country, and here's what I learned, that their biggest challenges are around the cost of regulations, and then right after that is access to affordable capital. So when you think about the one big, beautiful bill that President Trump signed into law this past summer, that goes into full effect soon, meaning after the first of the year, and they have access to 100% expensing for plants and equipment. Well, they need to get loans. What these lower rates mean is that they're going to have access to capital. It's going to give them the ability to buy equipment. It's going to give them the ability to build buildings. It's also going to give them the ability to hire people. And why that really matters for all of us is, as you know, John, we've been seeing these layoffs in what is a rapidly deteriorating labor market. And why I'm energized this morning is because with these lower interest rates and the one big, beautiful bill moving into full effect, we've got the ability to get jobs going through small businesses. 2 of 3 new private sector jobs come from small businesses. Half the workforce comes from small businesses. 99.9% of the companies in this country are small businesses. Everyone in your listening area should be very energized by about what's in front of us. But that being said, I will tell you, the Federal Reserve's work is not done yet. My hope was that they were going to reduce interest rates these past 3 meetings by 50 basis points apiece. So in my mind, they're probably 25 to 50 basis points away, because that would make capital even more affordable for small businesses. And in my mind, small businesses are where it's at.
Dan,
if
how
grow jobs?
Dan, how soon could we? Sorry to interrupt you. How soon could we see this actually take place? Because there's a trickle down effect, like you said. It's even though they lower it by 0.25 points, it's not like boom, it happens right away. Are we looking like a month, 6 months? How far out before we start to see these rate increases trickle down to borrowing and then businesses spending the money they were able to borrow?
Great question. So a year ago at this time, the Federal Reserve reduced interest rates by about 75 basis points. We're seeing some of that now. It takes anywhere from 6 months up to a year. But the reason why I think that timeline is going to be accelerated, John, is you've got small businesses wanting to make investments, and with the big, beautiful bill right in front of them. They've got the ability to access that capital because it's at a lower cost, and I think that we could see it sooner. What I expect, however, is I expect to see the trickle down between January and June, more likely at the end of the first quarter through the end of the second quarter. So if you and I were to talk on June 30th of next year, you and I would be celebrating the trickle down effect of these interest rates, return to growing jobs again, and improvement in the economy.
And this will likely line up very nicely because I understand Jerome Powell, his term is about up. It sure looks like Donald Trump's not going to reappoint him. And if I had to guess, Donald Trump will appoint somebody who is probably going to be more interested in dropping it by another 0.5 basis points, maybe even more, and that will really get the economy on fire, and it'll be in perfect timing for the midterm elections. So that will all look very good for the leadership, and it will also look very good for our economy. And I guess that's in the end, that's why we're all kind of cheering for something like this, because that way we can not only get the economy going, but also get the policies going that we want to see implemented in this country. Thank you so much for joining us this morning. That's Dan Varroney. He is the strategist and author of the #1 Amazon best-selling book, Rethinking Economic Growth.